Uber is one of the most used apps on Earth. Millions of people open it every single day. It operates in thousands of cities. It completely changed how the world moves. For most people, Uber is transportation now. You don't wait for taxis, you don't look up phone numbers. You tap a screen and a car appears. By every visible metric, Uber looks like one of the most successful companies ever built. And yet, after more than a decade, Uber has lost tens of billions of dollars. Not in theory, not on paper, in real money. Year after year, quarter after quarter, Uber keeps reporting massive losses, even as revenue grows, even as usage grows, even as the platform becomes more dominant. Which raises a disturbing question. How can a company that practically owns its market still be bleeding cash? And more importantly, why hasn't it figured out how to stop? The ride-hailing illusion. Growth that doesn't equal profit. At first glance, Uber's business seems simple. Connect riders with drivers, take a cut from every trip, scale globally, print money. That's how most people imagine it. And that's exactly how Uber sold the story to investors. The problem is that ride-hailing is not a high-margin business. It's a logistics business disguised as a tech platform. And logistics businesses are brutally expensive. Every single ride has real-world costs: fuel, maintenance, insurance, incentives, support, refunds, promotions, legal compliance, local regulations, driver churn, customer churn. Uber doesn't just run an app. It runs a global transportation network without owning the vehicles. And that means it has to constantly pay to keep both sides of the marketplace active. If drivers leave, riders wait longer. If riders leave, drivers earn less. So Uber is stuck subsidizing both sides just to keep the system functioning. This is the core illusion of Uber. It looks like software, but it behaves like infrastructure. Why Uber can't just raise prices? The obvious solution to losing money is simple: charge more. But Uber can't do that without breaking its own model. The moment prices rise too much, people go back to alternatives. Public transport, taxis, walking, competitors. The entire value proposition of Uber is convenience at a reasonable price. Once it stops being cheaper or easier, demand collapses. At the same time, Uber can't reduce driver pay either. Drivers already operate on thin margins. Many only stay because of bonuses and surge pricing. If earnings drop too low, they leave the platform. So Uber is trapped. It can't raise prices enough to become profitable. It can't lower costs without shrinking the network. And it can't automate the problem away because self-driving cars still don't exist at scale. Uber doesn't control the two biggest variables in its business: labor and demand. That's a dangerous place to be. The real cost everyone ignores. What most people don't realize is that Uber's biggest expense isn't marketing, it's incentives. Uber constantly pays drivers extra to stay active. It offers bonuses for completing a certain number of trips. It subsidizes fares in new cities. It discounts rides to beat competitors. It runs promotions just to maintain volume. All of this money comes directly out of Uber's pocket. In many markets, Uber literally loses money on each ride. Not a little, sometimes a lot. The only reason it keeps operating is because investors have been funding those losses in exchange for long-term dominance. This strategy works only if one thing eventually happens: monopoly. Uber's entire business logic depends on outlasting competitors, controlling the market, and then slowly raising prices once alternatives disappear. But that future keeps getting delayed. Why scale didn't save Uber? For years, Uber believed scale would solve everything. More users would mean more efficiency. More rides would reduce costs. More cities would mean better margins. That's how tech companies usually work. But transportation doesn't scale like software. Every new ride still requires a human driver. Every new city still requires local operations. Every new market still brings regulatory battles, lawsuits, and compliance costs. Uber scaled its problems along with its revenue. Instead of becoming more efficient, it became more complex. And complexity is expensive. The profit problem. Nobody wants to admit. Here's the uncomfortable truth. Uber may never become a highly profitable company, not because it's badly run, but because the economics of ride-hailing are fundamentally broken. Transportation is a low-margin industry, always has been. Airlines struggle, taxis struggle, delivery companies struggle. Logistics eats capital. Uber tried to turn a low-margin physical service into a high-margin digital platform, but reality didn't cooperate. No matter how advanced the app is, someone still has to drive the car, and as long as humans are involved, cost will always stay high. The business lesson: dominance doesn't mean sustainability. Uber is the perfect example of a modern business paradox. You can dominate a market and still lose money. You can reshape an industry and still fail to make it profitable. You can have millions of users and still run on investor cash. Uber didn't build a broken product. It built a business model that only works under perfect future conditions, conditions that may never arrive. Why Uber Eats didn't fix the problem. When ride-hailing failed to become profitable, Uber's next big hope was delivery. Uber Eats was supposed to be the second engine. Food delivery, groceries, packages, alcohol, anything that could move from point A to point B. The logic was simple: if people aren't always traveling, they're always eating. Delivery would balance out transportation and finally push Uber into sustainable profits. But the same problem appeared again. Delivery is even worse than ride-hailing. Food delivery has thinner margins, higher customer expectations, more refunds, more delays, and even more competition. Restaurants take a cut, drivers take a cut, customers demand low fees. Uber is left absorbing the losses in the middle. Just like rides, Uber Eats often loses money per order. And just like rides, it survives by subsidies, promotions, and incentives. Uber didn't diversify its risk, it multiplied it. Instead of one low-margin business, it now operates several low-margin businesses at massive scale. The tech company myth. Uber is often described as a tech company. In reality, it's not. It doesn't sell software. It doesn't license platforms. It doesn't build digital products that scale infinitely at near zero cost. Uber coordinates physical labor. That makes it closer to a logistics company than a Silicon Valley startup. True tech companies like Google, Meta, or Netflix create digital products once and distribute them endlessly. Their marginal cost is close to zero. Every new user increases profit. Uber's marginal cost never goes down. Every new user requires more drivers, more support staff, more insurance, more disputes, more infrastructure. Uber grows like a tech company, but it costs like a transport company, and that mismatch is fatal to profitability. Why Uber still exists anyway. So if Uber loses money, can't raise prices, can't cut costs, and can't automate, why does it still exist? Because it's too big to disappear. Uber has become infrastructure. Cities depend on it, airports depend on it, restaurants depend on it, millions of drivers depend on it, millions of customers rely on it daily. Uber isn't profitable, but it's essential. And essential companies can survive indefinitely on thin margins, debt, and investor belief. Uber's real business model is not transportation, it's expectations. As long as investors believe Uber will eventually become profitable, capital keeps flowing. As long as capital keeps flowing, Uber can keep operating at scale. It's not a profit machine, it's a financial balancing act. The dark truth about disruption. Uber is often celebrated as a symbol of innovation, but in reality, Uber exposed something uncomfortable about modern capitalism. Disruption doesn't always create better businesses. Sometimes it just creates bigger losses. Uber didn't eliminate inefficiency from transportation. It absorbed it. It shifted costs from consumers and companies onto investors and drivers. It created convenience by externalizing risk. It made transport cheaper not because it was more efficient, but because it was subsidized. This is why Uber feels affordable. Not because it's cheap to run, but because someone else is paying for it. The business lesson. Why some companies can never be fixed. Uber's story reveals a brutal lesson about business models. Some industries are structurally unprofitable. No matter how big you get, no matter how good the technology becomes, no matter how dominant the brand is, if your core service has low margins, high competition, and human labor at its center, Profits will always be limited. Uber didn't fail to execute. It succeeded in the wrong game. Uber is one of the most impressive companies ever built. It reshaped cities. It changed behavior. It became a global habit. But it may also be one of the clearest examples of a company that can never fully escape its own economics. Uber lives in a permanent state of almost. Almost profitable. Almost sustainable. Almost solved. Not because it lacks scale, but because scale doesn't fix broken math. And in the end, the biggest risk in business isn't failure. It's building something massive that can never truly make money. If you want more deep breakdowns on why dominant companies struggle, how business models actually work, and what separates real profits from illusionary success, subscribe to the channel. This is Profit Logic, and this is what happens when growth outruns reality.